We are looking at a company sitting on a guaranteed take-or-pay revenue backlog of nearly $100 billion. But at the exact same time, they are sitting on a powder keg of $24 billion in debt. That is the exact high-stakes mathematical paradox defining CoreWeave right now. We're looking at one of the most polarized AI infrastructure plays on the entire market. It's a company executing at literally unprecedented speeds, yet they are walking a financial tightrope where just one misstep could completely wipe out equity holders. So let's dive into this explainer and see what the market is actually pricing in. To really understand CoreWeave, you have to start right here. $99.4 billion. This isn't some rosy projection or a fuzzy total addressable market estimate. No, this is their actual contracted revenue backlog. We're talking about multi-year, non-cancelable, take-or-pay hosting contracts from some of the most powerful tech giants in the world. For the bulls, this right here is the ultimate proof point. It represents historic, multi-year visibility into future cash flows that practically no other company in the public markets can claim right now.
But here's the flip side, and honestly, the central conflict of this entire thesis. $24.8 billion. That's CoreWeave's total debt load as of the end of the first quarter of fiscal 2026. See, the company is funding its explosive hypergrowth through massive high-yield leverage. They've got less than $5 billion in stockholders' equity, which means their balance sheet is deeply, deeply fragile. So the ultimate question for investors is simply this. Can CoreWeave actually convert that massive backlog into cash fast enough to service this crushing debt load?
Okay, before we completely unpack the financials, let's quickly establish how they even got here, because CoreWeave's speed of execution is just undeniable. They were originally founded back in 2017 as a crypto mining operation, but they made a brilliant strategic pivot in 2019, transitioning their infrastructure into a GPU-accelerated cloud. Fast forward to a massive NASDAQ IPO in March 2025, and today, they are the largest specialized neocloud provider in the world, hoarding over 3.5 gigawatts of contracted physical power. In the AI era, power grid capacity is the defining structural bottleneck, and CoreWeave has essentially locked it up.
Now, you might be wondering, why wouldn't AI labs just use AWS or Azure? Well, notice how CoreWeave's primary economic moat fundamentally differs from those legacy hyperscalers. Traditional clouds use virtualization layers built for older legacy enterprise software, and that creates computational drag. CoreWeave instead rents out dedicated bare metal GPU clusters. This eliminates that overhead, it drastically reduces latency for massive AI training runs, and it actually lowers total cost of ownership by up to 30%. Add in a deep strategic partnership with NVIDIA that gives them priority access to the absolute newest chips, and you've got a highly defensible hardware-software ecosystem.
But here is what's keeping the market up at night. Extreme customer concentration. Just look at this revenue breakdown. Microsoft accounts for 45% of their trailing revenue. OpenAI is another 20%. That means a staggering 65% of their current revenue relies on just two entities. Sure, they're diversifying into sovereign AI and other enterprise clients. But think about it. If Microsoft or OpenAI ever decided to scale back their commitments, renegotiate terms, or just pivot to building their own internal infrastructure, the core thesis here doesn't just bend, it breaks. And by the way, if this kind of deep research-first analysis is your thing, you'll probably want to subscribe. It's just a quick click, and it's the best way to make sure you don't miss our next explainer. Now, let's pull back the curtain and look at the turbulent financial reality of their latest quarter.
Which brings us right into their Q1 2026 earnings, where we see explosive growth colliding head-on with crushing costs.
On May 7th, 2026, CoreWeave reported their first quarter results for fiscal 2026, and man, it triggered an immediate 11.4% drop in the stock the very next trading day. Let's break down the evidence here. Top-line revenue was absolutely explosive, hitting $2.078 billion, up nearly 112% year-over-year and beating analyst estimates. But look at the bottom line, a GAAP net loss of $740 million. Why? Because that incredible revenue growth was entirely eaten alive by surging depreciation on their massive hardware deployments, plus the massive interest expenses on all that debt. Their adjusted operating margin literally collapsed sequentially down to a razor-thin 1%. Management, however, fiercely defended this dynamic on the earnings call. They stated point-blank that this 1% margin represents the absolute trough for the fiscal year. They explained that this is an accounting timing mismatch, not a broken business model. See, when CoreWeave takes over a new data center, all the rent, utility, and massive depreciation costs hit the income statement immediately. But revenue recognition actually lags by a couple of months, while the clusters are physically installed and debugged. As their massive 1 gigawatt of newly active power comes online, they expect margins to recover sequentially, targeting a return to double digits by Q4. When we synthesize the qualitative metrics from the research, it gives us a much clearer picture of the overall business quality. CoreWeave scores incredibly high on growth outlook, a 9 out of 10, and market position sits at a solid 8. But those are severely dragged down by a 3 out of 10 for financial health and a brutal 2 out of 10 for profitability. Crucially, management alignment scored just a 5, and that's driven by the fact that insiders, including the CEO, have been aggressively selling off billions of dollars in stock since the IPO lockup expired, with zero insider buying. The blended score lands at 5.6 out of 10, cementing this as a highly speculative, levered growth vehicle. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is completely free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back it up. You also get Portfolio Watch, which monitors your portfolio and flags important changes; and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's get into the 5-year scenarios and actually run the math behind this leverage.
First, a quick but important disclaimer. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios. We'll start with the bear case, assigning it a 30% probability. In this scenario, structural AI demand slows down. Hyperscalers like Meta and Google successfully build out their own internal custom silicon, and a brutal pricing war for standard GPU hours crushes CoreWeave's margins. Revenue still grows, hitting $26 billion in year 5, but net margins compress to a painful 4%. Trapped by high fixed interest expenses, the company is forced into massive, dilutive equity raises. Applying a utility-like 12 times PE multiple gives us an implied share price of $19.20. That is a devastating 73% loss from current levels.
Now, in the base case, which we give a 50% probability, AI demand remains robust. CoreWeave successfully converts that massive $99 billion backlog and navigates its debt without real distress. By maintaining high occupancy across its data centers, year 5 revenue scales to an incredible $50 billion. Net margins stabilize at a healthy 15% as they hit operational scale. If the market assigns a standard 14 times tech infrastructure multiple, we get an implied share price of $175. That's a 143% total return over 5 years, or roughly 19.5% annualized.
And that brings us to the bull case, a 20% probability. Here, global compute demand completely shatters Wall Street estimates. CoreWeave doesn't just rent hardware anymore, they successfully pivot heavily into their high-margin proprietary software tools. Operating cash flow surges, allowing them to self-fund expansion, rapidly pay down debt, and even start buying back stock. Year 5 revenue hits $80 billion, with margins expanding to 20%. Valued at an 18 times multiple, the implied share price explodes to $496.55. That's a nearly 600% return.
So when you probability weight those 3 scenarios, 30% bear, 50% base, and 20% bull, the math outputs an expected 5-year target price of $192.57. This represents a highly attractive asymmetric upside from today's price levels. But, as we saw in that bear case, this upside comes paired with the very real risk of total equity wipeout if the underlying debt thesis fractures.
So what actually breaks this entire thesis? Let's look at the key structural risks. Aside from that intense customer concentration we talked about earlier, there are specific structural risks that could completely derail these bullish scenarios. Remember, this is definitely not a set-it-and-forget-it stock. The most fascinating risk here is technological obsolescence. See, CoreWeave aggressively uses a 6-year straight-line depreciation schedule for its GPUs. But silicon innovation is moving violently fast right now. Just look at the rapid jump from NVIDIA's Blackwell to Rubin architectures. If these highly expensive chips become obsolete in 3 or 4 years instead of 6, CoreWeave is going to face multi-billion-dollar asset write-downs. Second is liquidity freezes. They require constant access to high-yield debt markets to fund their $31 to $35 billion annual CapEx program. If credit markets freeze, CoreWeave halts, period. Finally, customer attrition. If a major player like Meta slows their model training, that contracted backlog could just evaporate. As the Carisdale Capital short report starkly noted, despite the high-margin software ambitions, CoreWeave is fundamentally a debt-fueled GPU rental business with extremely high interest costs. They are highly sensitive to macro shocks. Sustained inflation in electricity prices, which is the largest variable cost in AI factories, directly compresses their margins. Higher for longer interest rates make their massive variable rate debt way more expensive to hold. Ultimately, they are a macro-sensitive battleground masquerading as a pure AI play.
So let's pull all of this together into 3 core takeaways you need to remember. First, CoreWeave boasts unprecedented revenue visibility with a $99 billion contracted backlog. That is a massive protective moat. Second, that moat is built on a very fragile balance sheet that is heavily reliant on continuous capital market access. They quite literally need debt to survive. Third, the ultimate near-term catalyst to watch is whether management can actually deliver that promised margin recovery by Q4 2026 as their new gigawatts of power come online and revenue recognition catches up to their depreciation.
It all comes back to the paradox we started with. Will the $99 billion backlog convert to cash before the $24 billion debt burden crushes them? The asymmetric upside is clearly there, but the tightrope they are walking is incredibly narrow. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.